Okay, very good morning. It is Tuesday the 5th of December. Hope everyone is well. In terms of what we're going to cover in the briefing today, of course, we need to have an update on Brexit. I'm a little bit cheesed off that I missed the bulk of the price movement yesterday afternoon. It seems to be that whenever I leave the desk, it seems to spark volatility. So if I can dash in and out of the office to create some market moves for you, I will. Otherwise, other things to have a look at is this ongoing apparent sector rotation that's becoming increasingly more evident in the US equity market. We'll have a quick look at that. And we'll have a look at the RBA announcement from last night, some retail sales data which move their currency, and then we'll have a look on what's the agenda for today's session looking forward. So hopefully that's what we're going to cover. And first off then, let's have a look at the close on Wall Street yesterday. Looking at the S&P chart here, making this a bit bigger, we obviously had a gap up following the passage of the Senate version of the US tax bill. This came in the early hours of Saturday morning at the weekend, so we gapped up, we touched fresh record highs as we got underway on Wall Street, but then some profit taking from there forward, and actually we finished marginally lower in terms of the case of the S&P. You probably would have seen the tweet, a lot of people making a bit of a jibe on social media. Trump was tweeting at the open that check out the stock market, it's going to be great today, and obviously we finished in negative territory. So quite a funny tweet at the time from Donald, always well timed. But having a look then at this breakdown really of the US equity market, because as much as we saw a bit of a pullback from those elevated levels, I mean, let's just quickly go back and look at the S&P in a broader perspective, and it's still continuing to be, although volatility is picking up, we are really elevated in the grander scheme of things, particularly really since November. And so over the last month, this really strong move above 2600, although we came back in that big bout of volatility on Friday when that ABC News story broke, we're right back up there again. As I said, it was only in the last 24 hours we have touched record levels. Now, one of the things we touched upon briefly last week was this sector rotation that apparently is happening. And just want to quickly show you the heat map of yesterday's S&P 500 performance. And really this identifies the same pattern that was quite clearly evident after Jerome Powell spoke, which was, if I remember rightly, last Tuesday, which was his kind of congressional hearing with his nomination to succeed Janet Yellen coming into 2018. Now, one of the things I'm looking at here is the two biggest proportionate sectors of the S&P, so technology and financials. Roughly, those two sectors alone comprise of nearly 40% of the entire S&P index in terms of how it's broken down as a percentage weighting. And so these are the two most influential sectors. And what's been quite clear here is that when Powell spoke, one of the things that he said was that he confirmed his belief that bank regulation should not go further, and also with the momentum we've seen building with the tax reform package would pass the Senate, which is seen most favourable for the financials and least favourable for the tech names. And so what we continue to see then is some of these FANG so-called related names, so Facebook, Amazon, Netflix, Google, they tend to be highly sensitive to investor sentiment swings, and also the tech sector, don't forget, has been, particularly FANG names, big outperformers year to date. So as we're coming in towards year end, given the more favourable commentary coming from the regulatory front from Powell, you're seeing a bit of a rotation out of the outperforming tech and into financials, placing then going forward for the 2018 period. And this was definitely something which was, you can see here, Google, Facebook, Microsoft, the most red on the board comparative to the key money center banks, JP, Bank of America, Citi, Wells Fargo, and so on, which are the most green at this point. So just been quite interesting. Over the 5-day performance, the FANG names are down about 5.6%, whereas telecom and US financials are up 8 and 6.8% each respectively. just to give you an idea. So definitely, although there's some direction in the index, what's quite interesting is the underlying patterns and movements that are occurring on an individual stock basis, which of course is in fitting with some of the news flow that we've been seeing of late. Okay, a few other things just to quickly go through before we move on to the Brexit situation. Let me just bring the Aussie into view. So this is looking at the Aussie dollar future. And as you can see here, we've managed to spring higher at about 12:30 overnight London time. So if I just highlight this period, now the actual interest rate decision that came out from the RBA came out after the predominant rally in the Aussie currency. So the RBA rate decision actually was only this part. So what happened? And what took us then above technically the high that we had last Friday? Well, this bigger rally was down to economic data, not so much what the RBA said. And this was Australian retail sales for October. Expectations were for 0.3%, and the Aussie retail sale number came in at 0.5%. Not only that, although it was fractional, we did have a revision upward to 0.1 from flat. So overall, good retail sales picture as well. Going back to the chart though, we did see a further extension of Aussie gains up to these overnight highs, which are printed up here at 76.53 on the back of the RBA interest rate decision. As completely expected, they kept interest rates on hold, 1.5%. They reiterated a judge steady policy consistent with growth and inflation targets. One of the key things though, the acting governor did make a comment that did stick out. He commented that weak global inflation is assumed to persist in line with the forecasts of international institutions, which now puts some risk on the upside for inflation and interest rates. So therefore he's kind of talking with a slight hawkish twinge, if you like, on that latter point, which would be enough to also give the Aussie a little bit of a further boost. Going back to the chart of where we trade at the moment, obviously we found a bit of a floor here, most recent price action, although it has chopped through it a little bit this morning from that previous high that was on Friday, but a bulk of that price action is being able to be withheld, so to speak. The other thing that's happened overnight is the Aussie is often seen as a proxy for the Chinese economy, and you did have some Chinese data overnight, and you had the Chinese case-in service PMI, and that came in at 51.9. That was above consensus estimate of 51.5. So let me just show you the chart. It was the strongest growth in service activity in China since August. New orders increased the most in 3 months, employment grew further, and confidence strengthened. So looking at the pattern here, going through September, October, and the latest reading, we've had quite decent, consistent gains here in this service industry in China. And as I said, the highest reading now going back in service activity since August. So good retail sales, some commentary, maybe drawing some attention from the RBA rate decision in combination with some positive Chinese economic data has kept the Aussie somewhat elevated. The one thing to keep in mind though is a lot of this move has now already happened. So, you know, I wouldn't want to be just blindly trying to long the Aussie from here, because you have to put in that the market has repriced itself already fairly aggressively by around 50 pips from where we were last night. So just keep that in some context. Okay. Moving on, and on to the main event. This is the kind of the headline that's dominating much of the global press this morning. And of course it is to do with Brexit. Now let's just go back to the cable chart, because it'll probably make a little bit more sense if we look at that in more detail. And if I break this down to slightly shorter time frames, and really there's two isolated incidents we need to look at. That was one and this was two, and then we can look at where we are at the moment. So if you remember, it was just after 11 o'clock yesterday morning. That was when there was a breaking headline. An official was being cited, leaked from Barnier, that they've struck a deal. and actually that's going to be ratified when Theresa May met with Juncker and Barnier later that morning. The pound rallied pretty quickly, and we got up to the respective R1 on the daily pivots in terms of yesterday's price action. Then, if you look to, well, 1 minute chart, I think I had it. This was the initial rally that I've just spoken of. So you can see the initial headline break, and then the market slowly, as the news and information circulates, continues to remain bid through the 135 handle. We then held on to that, and it was around 12:15 when it was scheduled that May and those European officials were sitting down to ratify this agreement. However, as the day went on, I think my chart's just taking some time to just update here. One of the main things was we saw a big breakdown in price action after it became apparent, and it's just loading up here, this downtick here, that basically the deal was off. And the DUP, which we were following very closely, have scalped the deal, and apparently, just reading some of the press this morning, so again, I wasn't here in real time, unfortunately, to cover it, I was lecturing at the time, was that all was going well. Theresa May popped out to have a phone call with Arlene Foster, the leader of the DUP. She said she is not happy with the situation about the treatment for Northern Ireland and the issue of the border, and therefore Theresa May had to go back in and say basically we don't have support for the deal on our side. And then the pound quickly revalued to the downside, even quicker than the bid that was seen in the morning. So just having a look here, what was interesting was that it was pretty much mimicking a like-for-like type price movement, the size of the bid on the positivity that a deal might get done, and then completely taken back, but in an even quicker fashion. One of the interesting things here, this exactly happened, if you remember, last, I think it was Thursday, when you had that Telegraph story breaking, and the move took quite a while to build up, but when the rebuttal came, the move was extremely quick, and we've seen that again this time. That's because the unscheduled nature of the news breaking usually takes a little while to circulate, but once it's out there, then everyone is mindful and looking for the rebuttal and response, so the market can react much quicker. It's usually how the market functions in terms of an execution perspective. The thing we're looking at now then is, if I start to zoom out a little bit, let's look at the bigger picture for the sterling currency. And you can see this morning we've already started to weaken in cable. We've got through the respective S1, which was a fairly decent level, as that was the low print from the initial spike low that we had on the breakdown of those talks yesterday, close to around support points in the earlier part of the Monday open. You can see we broke, we came back to the S1, we've had a push further down on snapping through the 134 handle as well in the futures, which helped exacerbate that initial break and that wick you can see with some light stops being run. And we've come back to the handle as where we are at the moment. Now, this was actually the move I've circled here of when that Telegraph article came out about the divorce bill being settled with a higher fee. And this was the rally that we saw throughout the predominant part of last week. So if you think about it, if Theresa May is unable to really club together a deal here and get it ratified, or at least not ratified but agreed in principle this week, then you've got to think that cable's really got to come back down towards these levels, sub a 133 handle, to take back the positivity that had built up last week. As we talked about before, you know, the pound has shown a high degree of resilience under what is a high degree of political uncertainty. And a lot of this is based on the inevitability that a deal is going to get done. If a deal doesn't get done, and we're not able to achieve anything by the EU summit, which is only around 10 days away or so, then this pound needs to revalue for that proposition or situation. And then we start looking at broader targets down to the kind of October lows, which we're testing more 130.50 level, which would be key, opening up potential then for further downside if we go into 2018, because obviously we are working with a diminishing time frame, i.e. the Article 50 period of March 2019. So there's a lot to play for, and I would say this week continues to be incredibly important for the pound, and I'm sure there could be similar movement to like what we had yesterday could come as soon as today. A couple of things here just to wrap up what the FT was saying and give you a bit of context. So Northern Ireland's hardline unionists rejected Theresa May's agreement to potentially keep the province aligned with EU law after Brexit. Some of the main things here to look out for. Monday's failure endangers the planned timetable for the run-up to the EU summit, as I've just mentioned. Mrs May is expected to hold further talks with the DUP in the next 24 hours and has cleared her diary for a possible return to Brussels on Wednesday. So apparently, according to the FT's information, she's looking to go back to Brussels tomorrow. That means there's going to be a lot of closed-door, behind-the-scenes movements happening and conversations with the DUP today. So what does that mean from an intraday trading perspective? I have no doubt that at some point today, you will get a leak, a source, a comment, a tweet, something which will probably give you an update whether or not this Northern Irish issue is still remaining a sticking point to getting the job done, or there's some sort of solution that's found. Either way could be highly beneficial or negative for the pound. A couple of other points. The UK-EU draft referred to maintaining regulatory alignment between Northern Ireland and the Republic of Ireland after Brexit. But the key point here is that according to Arlene Foster of the DUP, Northern Ireland must leave the EU on the same terms as the rest of the UK and will not accept any form of regulation divergence which separates Northern Ireland economically or politically from the rest of the UK. So, as we've been talking about here at Amplify for the last week or two, it's this underplaying and appreciation of the complexity, I think, of this Northern Irish issue that I think a lot of people, in a way, were a little bit complacent on. So this is going to be the key thing that we're going to have to monitor as we go out for any potential headline market moving information, particularly the fact that talks are happening today. As she needs to speed up the timetable now, there could be a lot of headline noise coming in the next day or two. So that's the latest on the Brexit situation. On the UK situation, one other interesting thing that I've seen overnight, UK retail sales rise on food as Black Friday falls short. So this is according to the British Retail Consortium. This isn't the major Office of National Statistics retail sales report, so generally it's one of the lower hanging fruit, if you like, in terms of the importance of retail sale numbers, but it does point out quite an interesting thing. Food drove the 0.6% increase in like-for-like basis. So basically, people need to eat, and the price of food is going up, and so retail sales net is going up. The problem is that when you start to look down at the performance of Black Friday, what the data would suggest is that households still remain reluctant to spend on non-essentials. So, i.e., basic staples are going up, and that's saturating general disposable income, rather than people going out and buying TVs, iPads, things that are not necessary essentials in terms of consumer purchases. So, quite interestingly, Black Friday actually, from their data, appears to be fairly actually disappointing in that respect because of the squeeze on households. So that kind of narrative continues for the UK consumer. A few other things just quickly to show you. You've had this come out overnight. Goldman Sachs, they've lifted their 2018 oil price outlook on strong OPEC resolve. So the bank are raising their forecast for Brent crude for 2018 to $62 a barrel from 58, and WTI they're raising from to 57.50 from 55. So as you can see in the chart here, a fairly substantial uptick. They're looking at, in a nutshell, the resolve of OPEC. They've already made this extension, as we saw in Vienna last week. Goldman's now anticipate full compliance to the agreement to last longer, and for the exit from the pact to be less dramatic. And so just making you aware of that. Okay, looking at the calendar for today's session, there are a couple of interesting things to look out for, aside from obviously remaining quite vigilant for potential sterling movement on the back of any updates on the Brexit negotiations. You do have the UK service PMI coming out at 9:30. Now, as we know, the service industry absolutely critical for the functioning of the UK economy, that sector remains healthy. The previous was 55.6. We're looking for a fairly similar number. Looking at the UK service sector, the last reading did point to the fastest expansion in the service activity in 6 months due to a rebound in new order growth from September's 13-month low amid improved domestic demand and successful new product launches. So we had a really surprisingly strong number last service PMI, and obviously under the conditions that we're under politically, it'd be interesting to see a weak number. So let's say we get a number on a pullback back down to the lower bound of 53, let's say, or below, so a 12-month low, and certainly the pressure might start mounting on the currency. The one thing I would say is that, as you saw yesterday, UK construction PMI was very strong in the UK, and the pound weakened, didn't strengthen. That's because in the hierarchy of events that traders are assigning priority to, Brexit negotiations are absolutely key. Because, put it this way, even if the service industry is very strong now, and forecasts are going forward in the short term positive, if we have a cliff edge scenario and no Brexit deal is done and we have a worst case situation, then, well, you can forget about the PMI consistency of improvement. It's going to fall dramatically. So at the moment, the market is really monitoring economic data in the UK with some vigilance, but not assigning a great deal of priority unless it's significantly out of line. Because what's bigger at play in the context of this week is getting this deal done on these key issues, securing the transitional deal so they can get trade talks underway. So do keep that in mind when you're trying to look at and potentially trade data. The opportunity might not be as clear cut as it would normally be given the context. Okay, going back to the calendar, a few other things to be aware of. You've got the European retail sales at 10. This is very rarely market moving. Going into the afternoon, you get the US trade balance, but this is a revision, so that's going to be unmarket moving as well. Canada trade balance, import-exports, though, for any of the FX traders. Then going into the afternoon, really the focus is going to be on the ISM non-manufacturing, with some focus on the employment constituent to give us another piece of the puzzle in toward the expectations being formulated for the non-farm payrolls report we'll get this Friday. And then, as per usual, you'll get the API crude oil inventories in the evening after the close. Speaker-wise, aside from the politics, you do have the arch hawk Jens Weidmann of the Bundesbank speaking in Frankfurt. That's coming at the European cash equity close. Constancio is listed, but there's no set time, so just keep your ears peeled if the deputy does speak from the ECB. Okay, so just quickly, a quick finish on the charts. The dollar is a little bit firmer this morning, so both euro dollar and cable are seeing a little bit of downside pressure. Euro below pivot, but looking slightly more interesting is sterling in the context of already breaking through some of the low points from yesterday in that S1. Longer time frame potential reversal of some of the gains that were seen last week on the Telegraph EU divorce bill story, if there's no progression in these talks. Equity wise, still remain relatively, I'd say, bullish on things, although equity markets have pulled back slightly in the US. I guess this is really more about letting the market take some natural profit at these levels, but then identifying the next level of potentially getting long. I think I'd still remain more favourable to that. And then looking for the US session really to dictate proceedings. But if the tax bill continues to go as planned, then that still remains a net positive for the moment. So that's it. Sam has told me that he's marked up a couple of charts, some interesting levels and strategies that he's been looking at this morning. He's going to pop them in the Trading Live chat room. So feel free to have a look, and any questions, just let us know. Okay, guys. That's your morning briefing. Have a good afternoon, or a good day, I should say. Thank you very much.